The market right now is standing at a very critical point, and most people do not realize what is building behind the scenes. Big institutions, hedge funds, and automated trading systems known as CTAs are preparing for a major move. This is not a normal situation. This is a setup where markets can move very fast to the downside if certain levels break. These machines do not trade with emotions, they follow data, momentum, and price levels, and once those levels are broken, they execute large sell orders instantly. This creates pressure, and that pressure can quickly turn into panic selling across the market. Right now, reports suggest that these machines are shifting from long positions into neutral and even short positions, which means instead of supporting the market, they are preparing to push it lower. This is important because when machines sell, they do not stop easily. They continue selling as long as conditions remain weak. There is an estimate that nearly $70 to $80 billion of selling pressure could enter the market within a short time if key levels break, and this kind of flow can move markets very quickly. Now, starting with the S&P 500, this is one of the most important indexes, and a key level is around 6512. If the market closes below this level, it signals a breakdown. Machines recognize this as a sell signal, and once that happens, systematic traders begin selling in large amounts. This is not based on opinions or news, it is purely based on price action, and once the breakdown starts, it can create a chain reaction. More selling leads to more weakness, a ND that leads to even more selling, creating a strong downward move. Now, looking at the Nasdaq 100, the situation here is already showing weakness. The index is near a critical level around 24,057, and it is also testing the 200-day moving average, which is a major long-term signal. When price moves below the 200-day moving average, it is considered bearish, and it tells large funds that the trend may be changing. And when that happens, machines often begin shorting the market, which means they start betting on prices going down. This is where many retail investors get trapped because they continue buying dips without realizing that the overall trend may be shifting. Now, moving to the Russell 2000, which represents small cap stocks. This index often gives early signals, and right now it is already showing weakness. There is a key level around 2420, and if the index falls below this level, machines are expected to go into aggressive short mode. This means heavy selling pressure, and when small caps lead the downside, it usually indicates that investors are becoming more cautious and risk appetite is decreasing. Now, shifting to gold, which is usually considered a safe asset, even gold is showing signs that machines may start selling. There are key levels around 44.96 and 43.86, and if gold drops below these levels, it suggests that liquidity pressure may be affecting all assets. This type of behavior often appears during uncertain market conditions, where investors are forced to adjust positions across different asset classes. Now, looking at bonds and currencies, machines are starting to short shorter-term bonds like the 2-year and 5-year, and at the same time, there is expected selling in currencies like the euro and the pound, which can strengthen the dollar. A stronger dollar often puts additional pressure on global markets, and this shows that the current situation is not limited to stocks. It is a broader shift happening across multiple markets. Now, the most important question is, what should you do in this situation? The biggest mistake people make is reacting emotionally during market moves, either by panic selling or blindly buying dips. A smarter approach is to reduce equity exposure and keep some cash available. This gives flexibility to take advantage of opportunities later when prices stabilize. Another approach is understanding that there may be opportunities on the downside as well, where markets falling can create trading opportunities for those who understand risk. At the same time, strength in the dollar can also provide opportunities depending on how the market continues to move. The key idea here is to stay aware of what large players are doing and not just follow the crowd, because markets are driven by money flows, and right now those flows are shifting. Machines are preparing to sell, institutions are becoming cautious, and key levels are being tested. This does not guarantee an immediate crash, but it clearly shows that risk is increasing. And when risk increases, your strategy should adapt. You do not need to predict exact tops or bottoms. You just need to protect your capital and wait for better opportunities. Because in the long run, survival matters more than quick profits. Those who stay disciplined and manage risk are the ones who succeed. Opportunities always come after uncertainty, but only for those who are prepared.